I'm Alex Moat, and welcome to Winner Take All, where we talk about the constant battle between large tech monopolies and traditional incumbents. Steve Schwartzman famously, says when it comes to tech companies, he just doesn't understand how to value a company that doesn't make money. That's the really unique thing about Bumble at the time when they acquired it. It was a profitable business. If you look at their adjusted EBITDA from Bumble's S1, then they would say they are still profitable. You gotta take the adjusted EBITDA calculation with a little bit of a grain of salt. But we're going to be diving into the Bumble IPO. We're going to be looking at Roblox, their revised, rumored IPO price today, and a couple other interesting topics. So let's jump on in and check out what's going on here with Bumble. So if you don't know what Bumble is a Tinder competitor. If you don't know what Tinder is, the dating app, the mobile dating app that made the swipe right, phrase infamous. They've actually trademarked the swipe right slogan. Funnily enough, Tinder has, which is owned by Match Group, which is ultimately controlled by Barry Diller and IAC. So here you can see Bumble's filing to go public. This is in the past week or so. The company, launched by a former co-founder of the IAC-owned Tinder, is planning to go public here. 42 million monthly active users. But that's very different than how they make money. These companies make money by kind of selling you premium packages, better swiping functionality, something like that. I haven't been on the dating apps in many years. Luckily, I haven't had to use them. They have 2.4 million paying users. So it's a much smaller fraction. Those monthly active users, those are 2.4 million paying users throughout that period of 2020. So it's a small fraction of the 42 million. So let's take a step back and you say, okay, well, how is Bumble priced? Does it make sense to invest in a Bumble? So again, name of the show, winner take all. You have one or two dominant players in a given vertical. Tinder is definitely the number one dominant player. I think this is really a question of how dominant, right? Are we talking, is this Uber versus Lyft? Is this iOS and Android, which are, much more closely on the same playing field, or God forbid, is this Google search Bing? You don't want to be Bing in the Google search Bing comparison. So in order to get to that, let's first actually take a look at Tinder. Now, taking a look at Tinder is a little bit more difficult because they are rolled up inside of Match. Match was somewhat recently spun out of IAC. So if you actually look at Match's 10K, it's looking at the 2019, right? So it was published in early 2020, looking at the 2019 calendar year. And so, this thing has all of a bunch of different IAC holdings in it, right? Here's Match, here's Angie's List, which is a roll up of Angie's List, Home Advisor, and Handy. You got Vimeo in here. You got a bunch of other stuff in here. This 2 billion, see this 2 billion roughly number here in revenue? That is reportedly, so this is again 2019 calendar year, 1.2 billion of that is Tinder. So actually a little over 50% of Match's revenue, was Tinder in 2019. When we read through their quarterly filings, they haven't done their 2020 10K filing yet. But when you read through the quarterly filings, the thing that is really propping up Match, that white hot, fast growth, revenue growth, profit growth engine is Tinder. And then they have, they've rolled up some smaller kind of mobile first dating apps underneath Tinder. Like they own Hinge and they own some other things that, you may not be as popular. But anyway, if you say here that, okay, maybe Tinder is really going to closer to, 60, maybe a little bit above 60% of revenue for Match. Okay. And then we got to look at where Match is on the public markets here. So Match Group stock is about $37 billion. But again, you really want to compare apples to apples here with Bumble. You want to try and look at, what portion of that is attributed to Tinder and other kind of mobile related dating apps versus Bumble. Match is primarily going to be that website type of experience, a little bit different of a kind of workflow, business model, growth rate, more of a laggard than Tinder really is that growth engine, right? Their performance, though, throughout 2020 has been very strong. You can see here for the 3 months, so this is Q3 2020, they had about $640 million in revenue. For the first 9 months of 2020, they had about $1.7 billion in revenue. So you can see, right, in 2019, where they closed at about $2 billion for the calendar year of 2019, they had $2 billion. They were pacing at 1.5 through Q3. If they can have another 600 million plus revenue quarter in Q4, this is really like around a $2.4 billion, let's say, a 20% year over year growth here on a revenue basis for Match, which if you say 60% of that, maybe a little bit more is Tinder, maybe Tinder's around, if Match overall is growing at say 20%, maybe Tinder's growing at 25-30% revenue. They don't break out all the stats for Tinder, right? So you kind of need to intimate here a little bit. But let's say if Tinder is at 1.2 in 2019, maybe they're at 1.4 to 1.5 in 2020. Then if we just take a step back and we say, okay, Match is a $37 billion company. They got a roughly $2.5 billion revenue. So you've got well over a 10x revenue multiple here for Match. Where Bumble is at is when they were acquired for a few $1 billion by Blackstone, profitable. Revenue growth for them, it might actually be a little bit lower than where Tinder is. Again, this is Bumble's S1. It gets a little bit wonky in here because you got to add up this revenue number, it's because they had all these kind of weird corporate entities structuring. So that's why this reporting is a little bit wonky. So you got 375 million here, but you got to add in this 40 million. So really they're at like 415 million in that period, those first 9 months of 2020, okay? Compared to 362 million the period prior. So they had about an additional $50 million revenue growth. So it's about a 20% growth rate for Bumble here. And I think that's also a kind of a generous number. 15 to 20% growth off of the first 9 months of 2020 compared to the prior 9 months in 2019. And if Match Group overall is growing at 20% year over year, let's say, then, and that Tinder is outperforming within that, actually, I think Tinder is growing faster than Bumble is, which makes sense, again, because Tinder is the leader. That winner-take-all dynamic is, it's real. And it gives you a lot of advantages. So what should Bumble be worth if you see Match Group, close to a 15, 16 revenue multiple here? We don't know exactly where their Q4 is going to end up, but if you just kind of keep on pace, let's just call it roughly. You got a 15x revenue multiple for Match. You got Tinder, which is really kind of outperforming from within that. I wouldn't be surprised if you were to look at Tinder and you say, yeah, Tinder's got actually closer to, say, a 20x revenue multiple in what is kind of Tinder revenue. Let's call it at around 1.4, 1.5 billion dollars here. And then, the rest of that is really Match. Compared to Bumble, where should Bumble be valued at? Those are the real comparables here. they will say that they have their adjusted EBITDA is still profitable. Company's adjusted EBITDA expanded from $80 million to $108 million. There are a lot of expenses when you look at what you need to do on a GAAP basis, and now you're going public. So there is some truth to this. You don't have all the details that you would like, but there are some there's some validity to these numbers in the sense that it hasn't just wildly swung to being an unprofitable business now that they're going public. Or they're not burning cash to just support, say, a 15 to 20% year-over-year growth rate. That said, if you annualize this, I think they're at around a $550 million, $550 million in 2020 revenue if you kind of extrapolate that out. So what should Bumble be worth on this? You got a distant number two. You got revenue growth, which is slower than the number one player, which has a lot more capital, which has a head start, which has more than double the number of paying users. Bumble has 2.4 million paying users, and Tinder had 5.9 million subscribers in the fourth quarter of 2019. Again, so assume that this is actually in the sixes and they're growing this number. So somewhere in the sixes. So more than double, if not closer to 3x the number of paying users, which makes sense because Tinder's doing more than, somewhere 2 to 3 times the amount of revenue than what Bumble is doing, right? So some of that makes sense. The one thing which I actually think is interesting is if you actually calculate out revenue by average subscribers here, Tinder average revenue per user is actually a little bit lower than Bumble's by about 10 to 15%. So that is one thing that I think goes into the Bumble court here. But even if you say, look, if Tinder is anywhere from 15 to 20x revenue in the public markets, and where should Bumble be at? Maybe say around 10x revenue. Okay, now you're talking it's a $5 to $6 billion market cap company. Where does that net out with where they will list their price? Don't really know. The report here is that they're seeking a valuation of $6 to $8 billion. That to me is really on the high range of this. Okay, if you say, okay, maybe I can get comfortable with a 15x revenue multiple. Yeah, I mean, that's really tapping out, considering that's kind of where Match is. Match is way bigger. Match Group as a whole actually has the same, if not slightly higher revenue growth, not even considering that Tinder is definitely going to be outperforming Match Group as a whole. So to me, that 15x would really be on the upper limits of where I think just relative, being priced fairly at. That to me, that would really be on the high end. I could see 10, 12 being much more realistic. That would be actually closer to the $6 billion range. We'll see where it goes. IPO, the listing price and what happens after the thing goes public have been completely bonkers these past few months here. So just because the price shoots up, gang, doesn't mean that it's actually what the company is worth. If you want to play that game, power to you, but just be a little careful. Okay, that is Bumble. Roblox. So Roblox, this company is basically 4x its value in the past few months. I do think that their original price at around $8 billion was kind of the rumored valuation to go public, was absolutely low. When I was reviewing all the platforms in Q4 that were going public, Roblox was easily my favorite choice, hands down. That was an easy decision. DoorDash and Airbnb and all the other things that came out around the same period, they ended up going through with their IPO. Roblox called it off, I think smartly. And now they're looking at a direct listing, so it's not actually an IPO anymore. But long story short, where do you want to buy in on Roblox? What are the comps on Roblox? It's a little bit harder to get the right comps on this. Minecraft would probably be the best comp, but Microsoft owns that. So it's not publicly traded. I mean, it's a rounding error when it comes to Microsoft's overall profile. So what are the other comps? The media will like to say that Unity is a comp for Roblox. And if you look at Unity, you'd say, yeah, $30 billion, which is the rumored Roblox listing price. Yeah, that's a no-brainer. But I really don't think Unity is the best comp. They have a $40 billion market cap. Okay, this is nuts. $40 billion market cap. Look, the company's doing like a $800 million run rate. It's insane. I don't even if they're doing $1 billion in revenue, which they haven't released Q4, you don't know. What are they going to do? Pop to $250 million revenue in Q4? Even if you annualize that out and you say, okay, yeah, they got $1 billion run rate, which they don't. That's a 40x revenue multiple. I mean, that is bonkers. Unity and Roblox are very different. They're similar in the sense that you can build gaming experiences on top of them. But where it's very different is this kind of metaverse that Roblox has created, and the way that Roblox has all of these bookings relative to revenue. So when we covered Roblox a few months ago now, some of the key takeaways here was that the company is just printing money. And why are they printing money? Well, that is because bookings, they don't consider revenue. Bookings is this number, about $1.25 billion for the first 9 months of 2020. Bookings is I essentially paid real money to buy Roblox money, right? So I have now given Roblox $10 and I've received $10 worth of what they call Robux. So now that money has been received by Roblox. They've acknowledged it as bookings. You can kind of think about it as like GMV. It's not totally the same thing as GMV, but you could kind of loosely make the leap to consider it a GMV-esque number where there is some correlation between GMV to revenue. Their point here is that bookings is a kind of forward-looking indicator of where revenue will be. Revenue is considered, hey, I spent the Robux to buy this item, or, I spent the Robux in the game. Now that revenue has actually been actualized and actually booked as revenue. That is actually this number, this 588. So they had about 1.25 billion in bookings for the first 9 months of 2020, but they had a little under $600 million in revenue. So it's, maybe call it 45% of bookings is revenue. So why is that, interesting here? Because when you actually look at the company's free cash flow, when you actually look at, why this company is printing money, it's because of that bookings dynamic. When you actually look at their actual P&L, you'll see here that it's losses. But when you actually look at free cash flow, they're just printing cash. Because they're actually, yeah, okay, you lost, a couple $100 million, but you just took in double the revenue, right, in cash, in bookings, and that's just kind of sitting there. And what is the expense to Roblox when Robux get actualized? Nothing. It's just like this sword was purchased, literally ones and zeros. So that's kind of the beautiful part of the business. That's why I was so bullish on the business at $8 billion. Let's take a look at some other comps, which I think are a little bit better than Unity. You can look at Zynga, another social gaming business here, $11 billion market cap. They've been on fire throughout 2020, about a $2 billion revenue, up, call it 50% year over year for each quarter. They're just, they're doing very well because of COVID, and as are all of these kinds of gaming companies and companies benefiting from lockdowns and all this kind of stuff. So $2 billion revenue, you got a 11 and a half, almost $12 billion company. You got a 5 to 6x revenue multiple on Zynga. Okay, what's another one? Let's look at Blizzard. They make World of Warcraft. They make StarCraft. They make a bunch of different games. They're a much bigger company. Call it a roughly $8 billion run rate. Quarterly performance, good. You can see it jumping up here. March, it was actually down. Q1, it was down year over year. and then boom, strong bounce back Q2 and Q3 in 2020, back to that roughly 50% year-over-year growth. So if you got an $8 billion roughly company, because of COVID growing it, call it 50% year-over-year. These are big bumps, gang. You got a 9x revenue multiple. So if Zynga's in the 5 to 6, Blizzard's in the 9 range, where would Roblox be at 30 billion? Okay, compared to Unity's 40x revenue multiple, and that's even me giving them a very generous rounding up on their run rate. Roblox would be at, don't know where their Q4 is going to end up, but let's say they can pull off a monster Q4. Let's just say they get to $1 billion run rate again, which they're not going to get to $1 billion run rate. Okay, but let's just say, just to make the numbers easy, $1 billion run rate, $30 billion valuation, 30x. Okay, this would be the saving grace to me. Would be if you actually look at the bookings. If you actually say, if the bookings are a little more than double revenue, could you get this thing to in the 1.5, in the 1.5 to $2 billion bookings for the calendar year ending in 2020? And I do think, I think they'll definitely be in the 1.5. Are they closer to 1.5 or 2 billion in the bookings? I don't know. It's not technically revenue. So at 10x GMV, you consider bookings GMV, which is not totally, but even at 10x, if they do 2 billion in bookings, which is not revenue, which they probably are not going to do 2 billion in bookings, and you do 10x bookings multiple, it's still just $20 billion company. 30 billion seems high to me. That's where I'm netting out on this. 30 billion really seems high. I love the company. Company's going to do fantastic. The Unity valuation is just complete bonkers, and you really can't use that as an anchor. When you look at, even if you say these guys should command, we're jumping in and out of a bunch of different platform types. This is not apples to apples, right? Tinder, which we just were talking about, if they're at a 15 to 20x revenue multiple, and this company, Roblox, can get to $1 billion run rate, which I don't think they're going to do. Okay, right? Simple math. That's a $15 to $20 billion valuation. If you 10x bookings, also a stretch, you're at 20. To me, 20 really seems like the upper boundary for where I would feel comfortable on Roblox. I can't tell you, right? The public markets, right? I mean, they can do whatever they want. You can play that game if you want, but 30 billion seems high to me on Roblox. Company is amazing. 30 billion seems high. Everything's up though. I mean, look at Plaid. I mean, it just continues to hit all-time highs. It's in the 45s now since inception. Go full screen. Since inception, it's up 82, almost 83%. Past year, it's up 54, almost 55%. The volumes are really starting to get up there. Look at that. We actually hit 30,000 volume for the first time. That's pretty cool. It's building. Plaid's building nicely, and it just can't be stopped. These companies are not in Plaid yet. A Roblox, an Airbnb, a DoorDash. They will most likely pass, our diligence. Still got to do the diligence. You got to do the rebalance, but technically they're not in it. We got 51 platform stocks in it today. You can see all of that on Wisdom Tree's site here. Platforms. What can you do? Actually, the answer is you just get on the train. The train is not slowing down. So, okay. China, hearts, Amazon. What do I mean by that? Well, we've talked about Wish, where 97% of all the sellers on Wish are just Chinese manufacturers. And that's actually more and more what's happening with Amazon, which is not good news for Wish, by the way. 75% of the new sellers on Amazon are from China. It's the natural life cycle of particularly product marketplaces, where product marketplaces, they get scale by getting fragmented third-party supply from smaller sellers, usually like distributors, the middlemen in the industry. As the marketplace commands more demand and more demand, then it starts to want to cut out the distributors as a middleman and go straight to the manufacturer. We've seen Amazon be very aggressive about going direct to manufacturers in the United States. And we've covered this a myriad of times on the show about pre-COVID, 49% of the top 10,000 sellers on Amazon were Chinese manufacturers. Percent of new Amazon sellers based in China. Look at this. In Germany, it's 80%. In Europe, these numbers are even higher. They're actually averaging it out. The US is actually lower, maybe 65% here. You can see these numbers growing aggressively. The other overlay on top of this story is that a lot of the Chinese sellers dropped off of the platform throughout 2020 because of COVID, customs, shipping issues, fulfillment issues, just a bunch of stuff going on in the supply chain. So it does make sense to me a little bit that you see a bounce back here, right? Because relative to, there's drop off all over the spectrum with Amazon sellers having issues on Amazon because of supply chain and COVID. But relatively, a lot of the Chinese sellers experience some more hardship given the fact that they're in China. So it makes sense that you see a bounce back, but this is a pretty aggressive bounce back, right? If you consider you had 49% as kind of the average of 10,000 sellers pre-COVID, bam, now you're jumping up to 80% in Germany. Over 60% isn't too much of a bounce back. That actually seems a little bit more normalized here than what you're seeing in Europe and Japan. But this should be a real concern for any country that's trying to promote localized manufacturing, which I think should be a pretty, bipartisan just a logical conclusion that you want to bring manufacturing back and try and localize it. This does not bode well for that. Spoke on the last episode about that the entrenched tech monopolies. Twitter is not a tech monopoly, but the leading content social media platform companies that have market caps. Twitter, 35 billion. The other tech monopolies in the trillions now, but they're able to spend an obscene amount of money on content censorship. They'll call it kind of trust and safety. Now, the better label for it really is content censorship, i.e. fascism, content information war. What's interesting here, though, is that I found this article in the Financial Times, and it's actually from back in 2017. The article is called "Facebook Counts the Costs of Post-Truth Politics." Basically, it's Zuckerberg saying we're going to hire tens of thousands of people to put all the regulation and all the things in place. And this is what happened to the stock price, right? You actually saw Twitter stock going down, Google and Facebook unabated. And that's actually similar to what we're seeing today, where you see Twitter's censorship, which, relatively, they're way more overly aggressive. But you see the similar thing, right? This really shows you the dichotomy between really having that monopoly status where you are somewhat impenetrable or invincible from private competition, or for really kind of markets to run the course, their natural course, and have competition, figure out who the winners and losers are, right? When you have this disconnect, right, in terms of the monopolies can take these actions with little to no concern about any retribution or any fallout. This was actually the first time that I think the executives at Facebook and Google saw this, right? They said, we're going to have to hire tens of thousands of people Zuckerberg promised to invest so much in security that it would significantly impact our profitability. Facebook plans to hire or contract 10,000 extra staff, doubling the number of people working on safety and security. So doubling. They already had 5,000. This was back in 2017. And invest in technologies to better spot bots and posts from malicious sources. This is an analyst. It said it was hard not to model a decline in valuation. The exact opposite happened. Stock went up. Why did the stock go up? Because Mr. Weiser is saying, well, they got to hire 10,000 people and that could cost $1 billion, even if they're outsourced to countries like the Philippines. And what ended up happening is now you're actually seeing this as a barrier to entry. You're actually seeing this as a moat around the tech monopolies here, where now they're saying, well, if this is 2017, Facebook already had 5,000 people working. Then Zuckerberg said, we're going to go hire another 10,000. Okay, now you're at 15. You don't think they've added to that number in the past 3 years? I bet there are over 20,000 people doing some form of content censorship, trust and safety. Here is, their operating costs. But this, these numbers are now going even higher. This is just through 2016. This is really before, these kind of memos came out from Zuckerberg and the likes, that we're going to have to spend billions and billions of dollars on all of this. So now what's happening is the expectation that big tech is trying to co-opt with the media is that if you don't have at least hundreds of people doing content censorship, you're a extremist, little watering hole, harboring terrorists and all this malicious activity. And sorry, gang, it's just not true. You don't need to spend hundreds of millions of dollars, even tens of millions of dollars, to have a viable, legal content platform or social media business. These companies, which are spending, these companies being Facebook, Google, Amazon, Apple, but in a little bit different way, and Twitter, have now viewed this as a competitive advantage because Facebook's got over 20,000 people. They're spending billions of dollars a year on trust and safety. We just talked about Telegram on the last episode. Telegram saying, I got over $200 million in server costs. They don't actually make any real revenue. And they're just trying to do a fundraise to keep the servers on, to literally keep the lights on. Now you say, hey, Telegram, which has over 500 million users, which signed up, I think, 30 million users in 7 days. I mean, it's insane. The exodus to these alternative content, social media communication platforms, and it's only going to continue because these tech monopolies have violated the ethos of platforms, and there's no walking that back. They've opened Pandora's box. We've seen their true colors for months and quarters and actually years here. We've been covering it on the show. But I think now a lot of people have really woken up that it's untenable and unacceptable. And that's why you see this diaspora away from these entrenched tech monopolies. And now this is where it comes back to private competition, right? Where can private competition level the playing field? When the market responds, when the users say this is not okay, I'm going to leave. Can private markets enable that to happen? And what you've seen instead is now you've seen you've actually seen the tech monopolies band together to help each other. Where is the DOJ on the antitrust on this? We've actually already seen, we covered it on the show called Project Jedi, where Google and Facebook literally have written agreements to help each other to form a digital advertising duopoly and to keep the competition out of the digital advertising spectrum. Actually documented that they're working together. Before all of this, right? Before Parler gets kicked off of AWS because Parler isn't spending millions of dollars on sufficient content censorship. And then they're branded an extremist social media platform. And boom, their apps are removed from Apple and Google. Amazon takes down their servers. This is the narrative. And these companies are small. So how are you supposed to compete when now they say, well, you're not doing sufficient censorship. There's no law around this. Who makes up the expectation about what is sufficient censorship, if not the laws, right? This is what the Poland justice minister said, right? If the tech platform, content platform, social media platforms in Poland violate our laws of free speech and kick someone off of their platform, we can fine them $2 million for every instance, right? Poland's figured this out. The EU is slowly getting to this, but now because it's coming so partisan, we'll see if the EU actually is able to stay objective and keep their thumb on the pulse of this whole thing. But the narrative now that it's up to the tech monopolies to determine what is appropriate censorship, if they're going to allow your app to be on the App Store, or if they're going to allow their servers to power your business, is completely ridiculous. Because these guys are spending billions of dollars on it. They had over 20,000 employees. You don't think they have a bias? They love the censorship. They see it as a competitive advantage. No one's seeing that this is completely inappropriate and they shouldn't be making the rules. There's clear precedent for laws. Is the FBI launching an investigation? Is your business not complying with U.S. law, not taking down information that is clearly violating, U.S. law? And now it's just kind of been, boom, co-opted into what, they think is appropriate levels of censorship. And you're not able to have true private competition. You're not able to let the markets work themselves out when you have the tech monopolies teaming up with each other to gang up on the smaller competition. From Telegram all the way down to my 5 oxymorons, which I covered a few episodes ago. These are the 5 up-and-coming content social media alternatives that are all top 1,000 websites in the United States. They have collectively raised less than $50 million. Probably total employee count at all these companies is probably less than a few hundred employees. Yeah, but they're supposed to go spend millions and tens of millions of dollars. No, actually, scratch that. Hundreds of millions of dollars on content censorship. It's actually genius by the tech monopolies here. And they've now whipped up the media into it. They've made it a partisan issue. But we got to take a step back and not get dragged into this. This is how you stamp out competition. This is how you stamp out letting the markets speak for themselves. When you get the tech monopolies teaming up with each other and just arbitrarily deciding what's appropriate levels of censorship. I mean, it's frankly laughable, but not many people are really talking about it, or they're too scared to talk about it, or it's inappropriate to talk about it. But it's absolutely ridiculous. People are waking up. People are waking up. And I've always said this. I'll end on a very positive note here. The American people, actually not just the American, people are smart. Not just the American people, people around the world, people can see what's going on. They're not happy with it. They're not okay with it. They're trying to leave the grasp of the tech monopolies. But now they're being, met with resistance at every step of the way. That's not how the markets are supposed to work. These companies will still do very well, and they're still actually succeeding despite all of that. Before all of this set into motion, they were already top 1,000 websites, right? They're already top 1,000 websites. Those stats are from a few weeks ago. So now just imagine what those stats are. A lot. If they can actually get the servers to work. Because now their apps have been kicked off the app stores. Insane. The fight will go on. I think the alternative players will certainly give the tech monopolies a run for their money. I think Parler has filed an antitrust suit against Amazon, which I think has a lot of legs. We'll see if they get a fair shake in court. Don't hold your breath. And but people can make up their minds. People can vote with where they spend their time. That's ultimately what it comes down to. So that's it for us on Winner Take All. Thanks very much for joining us. Talk to you soon.